Think about this for just 1 second. You wake up this morning, grab your phone, and check the silver price. $74 per troy ounce. Looks completely normal. Nothing unusual. Everything seems fine. But then someone shows you another number. Shanghai Gold Exchange. Same moment, same metal, same ounce. $86, a $12 gap. One metal, one planet. Two completely different prices. And nobody is talking about it. Not Bloomberg, not CNBC, no breaking news alerts, no analysts interrupting their programming to explain what this number actually means. Why? Because if this number gets properly explained, if someone actually sits down and walks you through what this $12 gap really means, you would turn off your television, get in your car, drive to your nearest coin dealer, and find out the shelf is already empty. The metal is gone. It went to Shanghai. I am going to prove that to you today. Step by step, number by number, no hype, no drama, just facts and analysis. I am your host, and this is our channel. Today we are talking about China's silver rush, the SGE premium, and the real story behind this $12 gap that mainstream financial media is completely ignoring. Quick disclaimer before we dive in. Nothing I say today is financial advice. I am showing you data and walking you through analysis. The decision is always yours. Always do your own research. Now let us get into it. To understand what is actually happening, you first need to understand something that most people get completely wrong about silver pricing. Most people assume there is one global silver price. One number, same everywhere. That is not how it works. There are two major pricing centers for silver in the world. The first is COMEX, the commodity exchange in New York. This is theoretically the global benchmark for silver prices. When you pull up silver on any financial website, the number you see is almost always the COMEX price. But here is something that most people never learn about COMEX. 95 to 98% of all trading on COMEX is settled in cash. People buy contracts, positions get opened, numbers move up and down on screens, but actual physical silver never gets delivered. Cash changes hands and the contract closes. That is it. No metal moves, no bars change hands, just numbers on a screen. The second pricing center is the SGE, the Shanghai Gold Exchange. China has been systematically building this exchange since around 2016 as an alternative pricing hub for the Eastern Hemisphere, and the SGE operates in a fundamentally different way. Physical delivery actually happens there. When Chinese buyers go to the SGE, whether they are industrial manufacturers, jewelry producers, solar panel companies, or state-linked enterprises, they expect actual metal, physical bars, real silver they can hold, use, and store. Not a cash settlement. Not a paper contract. The actual thing. This distinction is everything. Because when you see an SGE premium of $12 over the COMEX spot price, you are not looking at a pricing glitch that some algorithm has not caught yet. You're looking at the market telling you in plain numbers that physical silver available for delivery in the East is dramatically scarcer than the paper price in the West suggests. The paper price says 74. The physical reality in Shanghai says 86. The premium is the truth detector. And right now, it is reading $12 and climbing. Now let me give you some historical context because this is where things start getting really important. We have seen SGE premiums before, but the pattern of what happens after they appear is remarkably consistent. In late 2013, gold SGE premiums hit approximately $50 to $60 over London spot prices. Western analysts looked at it and said, "Relax, it is temporary, it will correct itself." A few months later, COMEX gold inventories had dropped by approximately 34%. The premium was not noise, it was a signal. In 2020, during the COVID supply chain crisis, silver premiums at the physical retail level exploded to 20, 30, 40% above spot prices as refineries shut down and dealer inventory disappeared almost overnight. And what happened to silver prices in the following 18 months? Silver went from $11 all the way to $30 per ounce. The premium came first. The price followed. Then, in 2024, during a period of significant physical demand from Asian industrial buyers, the SGE premium on silver averaged between $4 and $7 for months. We are now at 12, nearly double that average. And it is still building. So the obvious question is, how does this actually work mechanically? What is the process that connects a $12 gap in Shanghai to the fact that your local coin dealer might be out of stock right now? Picture a large Western bullion bank. It does not matter which one. They all run versions of the same trade when the math makes sense. This bank has access to a significant amount of physical silver sitting in London or New York vaults. The bank looks at the spread. COMEX spot at 74, SGE equivalent at 86. It does the math. Shipping silver from London to Shanghai by air costs between 40 and 80 cents per troy ounce. Insurance adds another 30 to 50 cents. Import duties, regulatory clearance, refining to meet SGE bar specifications. All in, a well-optimized operation spends around $2 per ounce total on moving costs. So the net arbitrage profit is approximately $10 per ounce. Buy silver in the West at 74, ship it to Shanghai, deliver it at 86, pocket $10 on every single ounce. 1 metric ton of silver is roughly 32,000 troy ounces. At $10 net profit per ounce, moving 1 metric ton from west to east generates $321,000 on a single shipment. Now imagine doing that with 50 metric tons per week. That is 1.6 million troy ounces. At $10 net per ounce, that is $16 million per week in pure arbitrage profit, every single week, for as long as the spread holds. This is why metal is flowing east. Not because of some secret conspiracy, because cold financial math makes it the most profitable trade available when the gap is this wide. But now the critical question: why does the gap stay open? If arbitrage is supposed to close price differences, why is this one persisting and actually growing? This is where most Western financial analysis completely misses the point. Western analysts keep looking at Chinese silver demand through a cyclical lens. They say when the Chinese economy slows, demand will drop and the premium will close. They are fundamentally misreading what kind of demand this actually is. A very significant and growing portion of Chinese silver demand in 2025 and 2026 is not consumer demand. It is not jewelry demand. It is strategic accumulation. Sovereign-level decision-making happening through commercial channels. And when demand is strategic rather than cyclical, it does not respond to price signals the same way. A regular manufacturer might slow purchasing if silver gets expensive. A government-level strategic stockpiling program does not. When a nation-state makes a determination that silver is a critical resource that needs to be secured, the price sensitivity of that demand approaches zero. They are not buying because it is cheap. They are buying because they have decided they need it before someone else gets it first. What specifically are they using it for? Solar panel manufacturing is probably the biggest single driver. China controls approximately 80% of global solar panel production capacity. Each panel requires between 15 and 20 grams of silver that cannot be substituted without catastrophic efficiency losses. There is no workaround. The silver goes in the panel, or the panel does not work properly. Beyond solar, electric vehicle charging infrastructure, 5G antenna arrays, modern defense electronics, drone components, precision guidance systems. All of these carry significant silver content. Every nation currently rearming, and there are many doing exactly that right now, is implicitly creating silver demand through defense procurement budgets. And then there is the monetary reserve accumulation angle. China has been quietly converting U.S. dollar reserves into hard assets for years, gold first, which is visible through official reserve reports. Silver is the quieter operation because it does not have to appear on a central bank balance sheet in the same way. It can move through state-owned enterprise balance sheets and sovereign wealth fund subsidiaries without the same visibility. It is the ideal reserve accumulation asset for a country that does not want to telegraph exactly how aggressively it is repositioning away from dollar dependency. Now, let me show you some specific numbers because this is where things get genuinely serious. COMEX registered silver inventory, the metal actually eligible and available for delivery against futures contracts, currently sits at approximately 170 million troy ounces. At $74 per ounce, that is roughly $12.6 billion worth of registered silver. Sounds substantial. But here is where the math gets uncomfortable. The open interest on COMEX silver futures right now is approximately 150 to 200,000 contracts. Each contract represents 5,000 troy ounces. At 175,000 contracts, you have 875 million ounces of silver represented by paper contracts, against 170 million ounces of registered physical silver. That is a paper-to-physical ratio of approximately 5 to 1. 5 paper ounces for every 1 physical ounce available for delivery. And when you factor in the London OTC market, where the same physical bars have been pledged as collateral across multiple agreements, the effective global paper-to-physical ratio for silver is estimated to be somewhere between 100 to 1 and 300 to 1. The system works as long as almost nobody actually demands physical delivery. The SGE premium is the signal that this assumption is starting to break down. Eastern buyers are demanding physical, and the pool of physical available to meet that demand is not nearly as large as the paper market implies. If the current arbitrage is draining somewhere between 5 and 15 million ounces per month from Western vaults into Shanghai, and COMEX registered inventory sits at 170 million ounces, you can do that math yourself. The timeline it implies is not comfortable. Now, there is a regulatory dimension to this story that almost nobody in mainstream financial coverage is discussing, but which matters enormously for how this unfolds. Basel IV is the updated international banking regulatory framework implemented progressively since 2023. One of its key changes was to the capital treatment of unallocated precious metals positions at banks. Previously, banks running large short positions in paper silver could carry those positions at relatively favorable capital ratios. Under Basel IV, these unallocated positions require substantially more capital. This makes being structurally short paper silver more expensive for the large banks that have historically used these positions as part of their precious metals business. As capital costs rise, the economic rationale for maintaining these massive short positions weakens. Banks are slowly and quietly reducing those positions. When structural short positions get reduced, the price suppression mechanism that has kept paper silver prices compressed becomes less effective. When that mechanism weakens, the paper price becomes more responsive to physical demand signals. And the physical demand signals right now are extremely strong. Basel IV is the institutional tailwind quietly amplifying everything else we have discussed today. Now let me address the obvious counter-argument directly because you deserve the full picture. The standard economic argument for why this premium should close naturally goes like this. High prices attract supply. If silver is worth $12 more in Shanghai than in New York, every holder of physical silver anywhere in the world is incentivized to ship it east. Supply flows to the highest price. The premium closes. Market equilibrium is restored. This is basic economics, and it is not wrong in theory. The arbitrage trade is running. Metal is flowing east. The mechanism works. But here is what basic economics does not fully account for. Supply flows to the highest price only when the supply actually exists and can be mobilized. What happens when Western physical supply reaches critically low levels? What happens when the metal that would normally flow to close the premium gap simply is not available in sufficient quantity? The premium does not just persist. It accelerates. It becomes self-reinforcing. High premium signals scarcity. Scarcity justifies even higher demand from buyers who correctly read the premium as an important signal. Higher demand depletes supply further. Lower supply pushes the premium higher still. We have seen this dynamic before in other commodities. Palladium in 2019 went from approximately $900 per ounce to over $2,000 in a single year. Uranium went from roughly $10 per pound in 2004 to $130 per pound by 2007. When a commodity with inelastic demand hits a genuine supply wall, the price adjustment is not gradual. It is sudden and dramatic. The preconditions for this kind of dynamic in silver are all present simultaneously right now. Let me bring everything together with the clearest summary I can give you. The $12 SGE premium is not noise. It is not a temporary inefficiency. It is a structural signal that a major state actor has made a strategic decision to exchange paper financial claims for physical silver at whatever scale Western vaults will accommodate. The arbitrage mechanism flowing metal from west to east is mathematically self-terminating. It ends either when COMEX prices rise enough to stop the outflow or when COMEX inventory falls to levels where the paper market cannot sustain its current structure. Neither of those endings is painless for anyone holding paper silver claims. The Basel IV regulatory shift is simultaneously removing the institutional suppression mechanism that has kept paper silver prices compressed for years. The COMEX paper-to-physical ratio at 5:1 against an estimated global ratio of 100 to 300 to 1. When London OTC positions are included, represents a system that requires near-perfect confidence in paper claims to function. That confidence is being stress-tested right now by physical buyers who are not interested in cash settlement. I am not saying the system collapses tomorrow. I am not making a specific price prediction for next week. What I am saying is that the mathematical structure of the current situation does not support the status quo persisting without a significant resolution event of some kind. And the preconditions for that resolution are accelerating rather than moderating. What do you do with this information? Pay attention to the premium, not just the paper price. The COMEX registered inventory number is publicly available on the CME website and updates daily. Watch it. If it drops toward critically low levels, that is meaningful information. Watch the SGE premium. If it moves from 12 to 15 to 20, each increment is telling you physical scarcity is deepening. And if you are going to hold silver, understand what you actually own. Physical metal in your possession is a fundamentally different thing from a paper claim on metal. In an environment where physical supply is genuinely constrained, that difference matters. The $12 gap between what Wall Street says silver is worth and what Shanghai is actually paying for it today is the most important number in the precious metals market right now. Every day that gap exists, and every ounce of metal that flows east to close it, is one more data point in a story that has historically ended with a significant price adjustment. Watch the premium. Watch the inventory. Make your own informed decisions with the full picture in front of you. I am your host. This is our channel. If this analysis helped you understand what is happening in the silver market right now, share it with someone who is trying to make sense of global financial markets. All the data we covered today is publicly available. COMEX inventory reports on the CME website, SGE pricing data, Basel regulatory documents, Treasury International Capital reports from the U.S. Treasury. Everything is out there for anyone willing to look at it carefully. We will see you in the next one.